we want to work this problem. I don't know who worked it. Do we have any volunteer who wants to work it for the class? Anybody feel confident? That's when you know it, when you can, although you think you know it when you're in front of a crowd. Right, so the exam's next Tuesday, right? You have the essays that are due. We'll see, I might make them do 6 o'clock the day after the exam or something. This probably the last time I'll have it open book like this, so take advantage of it. Get them written in advance. If you want to come talk to me, I won't like get you to a perfect answer, but I'll certainly tell you if you're missing something major. And then you have this one math problem, which everybody's figured 100 on this. It's very straightforward. Before I do that, we've had a few people apply for the scholarship. ICT emailed me. It's like, why don't you have more? So a few more of y'all want to apply. You have until the 7th, which is about a week from now. So I encourage you. It's open to everybody. It works really well for actuaries because they definitely want to be in that industry, but you don't have to be an actuary, any finance major. So I encourage you to apply for it. So, all right, let's look at this problem. We'll finish up annuities tonight. We'll do this problem. I want to show you something on the USAA site, which means USAA is going to be calling me this week, trying to sell me something, but it's all right. We'll use their calculator. And then we'll do one last thing on annuities, and then we'll get into the bizarre world of healthcare reform. So you get a problem that will look exactly like this. You get this data up front. It asks you, essentially walks you through the problem. So the first question is you figure out a future value and you get the present value. So the future value is going to be some dollar amount times 1 plus a rate raised to time. And the present value is going to be the future value. So this dollar amount here is a present value, future value divided by 1 plus a rate to time. So make sure you have those two in there. This is real popular. If you take my property and casualty course, we did this with the catastrophe bonds, very, very, very similar type of calculation. So in this case, what's my present value here? 300,000. And what rate do we have to pay them? So that's that guaranteed rate. And what's the years? 10. All right. What'd you get for that? That's you. Okay, and you can round right, round up or down. Anybody else agree with that number? So good. All right. So we take that 411,072, and what we're going to divide it by? Not 32 here. Yeah, I don't know why I went out that many decimal places. And then again, 10 years. And here you better get something less than 300,000 or you're in trouble. What did y'all get here? 95, I agree with that. So that is the actual answer. So look at the question. How much should you buy of this bond? And it's 248. Why? Because if you buy 248,000, invest it at 5175, you will have enough to give them their 3.2%. All right, any questions on that one? All right, the call options, you have to ask the difference. So here you're going to take the premium minus the bond investment. So here they came in with 300,000 bucks. You invested 248, 195. So what was that? 5. All right. So then you have to get the number of not contracts, but number of options. Remember, we're not doing contracts. So you got 51,805. How much is each contract? 1,400 because and it's at the money, right? 5,700 to 1,400. And how many contracts you get there? 47? 37. So there's your answer there. And you can write it just like this, but I would write things out. If you show me what you're doing, if you have a math error, I can give you full credit. If you just write 38 or well, 38, I might give it to you. But if you write 47, just because you accidentally divided by 1200 instead of 1400 or something, then I can't give you. So I'll write out. Now I had a professor once count off because we didn't write the number of options is 37. He says count off because we're not using complete sentences. And I was like, give me a break. But he said the exam grades were so high he had to do that. And so I told him, make your exams harder, and that made him really mad. So so I don't require complete sentences, but do show your work. So I know you understand the problem. You might have something where you practice the problem with 8 years so much, you use 8 instead of 10. And it's just like, I can see you understand the problem. You just picked up the wrong number because you're practicing one too many. All right. So here here you already have take the first part of the table, right? How much are you going to have in the bond portfolio? Yeah, exactly what you did here. So you just bring that down. And the call option, you remember the gain on the call option is, I don't know why we switched to a whole new font, but anyway, Bill Gates thought I wanted another font. Max of the market minus the strike and 0 times the number of options. So our strike is 5,700. So if you subtract 5,700 from 1985, you're going to get 0. If you subtract 5,700 from 5,700, you get 0. So the first two are 0 and 0. So that just gives us back that 411,072. And we know our return already, right? Because that's going to just be their guaranteed return of 3.2%. So you can fill in a lot of the table right at the start. So the only thing we do is calculate this bottom one. Let's see if I can get it back to the Calabria. Whoa, not even an option. So in this case, it's the max of 14,785 minus 5,700 and 0 times 37. What did y'all get on that one? 306. Okay. 36. 145. I agree with that one. Okay. Oh, I was kind of expecting a higher number, but that might work. Probably because our guarantee is a lot higher here. So you add those two together, 447, 207. I can't do that in my head. What is that? That's not high enough. 17. All right. And then your returns, it's going to be ending over beginning raised to the 1 divided by n minus 1. So should you memorize these formulas? No, these are two formulas you should just know. If a finance major, actuarial major, I bet both of these are on the actuarial exam, part 2. And every finance major knows how to calculate an annualized return. So don't memorize them, just know them. They're kind of basic to what you should know as a finance major. So we've already calculated these two. This one's pretty simple, 0% for the market. So we just got to calculate this one. This one's going to be 747, 217 divided by 300,000 raised to the 1 divided by 10 minus 1. What did y'all get there? Sounds about right. 956. Anybody else agree? Yep. All right. And then on the S&P, we got 1985 divided by 5,700 raised to the 1 over 10 minus 1. Anybody know what that is? Right at 10%. Yeah, I do try sometimes, don't bet on it, and make it an even number. Yeah. Yeah, I try, and that's, I mean, you can tell it's, I start with the 5,700, pick a return, and then that gives me that last number. So I usually am. And then over here, 14,785 divided by 5,700. Is that one 10% too? So this looks pretty good, right? Your upside getting most of it. So I probably have the premium on the option a little too low. All right, so you fill in that, you can tell a lot of it is, even before you start, you got it from question A and from just the notes, so it's pretty straightforward. This number is going to have to be lower than that number. So if we bring these numbers over, this is where you do the graph. Already have it set up somewhere. So 3.2's the minimum you get. Here's the stock market. At some point they have to cross again. I think I'd probably set the premium too low, but you need a graph that looks somewhat like this graph. Why do I want you to do the graph? This shape right here, this hockey stick, is a very, very famous shape in finance. That's that limited downside. You're trying to get as much of the upside as possible. This one looks pretty exciting. The stock market falls 40%, you'll make 3.2%. If it's up 20%, you'll probably make 16, 17%. This is the strategy I call smile when everyone is laughing and laugh when everyone is crying. That's my strategy. In the wrong font, but that's still my strategy. I like it. It's a good strategy for 60, 70-year-old, 80-year-old people that can't afford to lose 40% of their portfolio. This is a great strategy. Just don't buy it from an insurance company and expert linked annuity because they're going to charge you massive fees. But if you build it yourself, it's a really, really powerful strategy. All right, I'll save this out there as the solution. So I'm going to save it somewhere so I can find it. So any questions at all on the exam?
We're going to have to handwrite the graph.
Yeah, you have to draw the graph. Yeah, you won't have Excel. Yeah, it's got to be a calculator. I put it in the wrong spot. Nothing happens. Okay, well, I'll figure it out here. It's right now, if you want to know, it's under annuity products. It should be, finally. I'm not real good with slow computers. Yeah, it's not letting me do anything. I'll delete this out of the YouTube, but yeah, that's terrible. I don't know where it is. Somewhere it's telling me. All right, let's All right, it's down there too. All right. So the exam guide does have a bit of a rubric to it, not exactly a rubric, but it does, on the essays, does give you a list of things to make sure you cover. Same thing on the second essay question. And then you have what we just did there, all right? So no ambiguity. It's not like you don't know what's on the exam. And now it's out open books thanks to COVID, so I mean, it should be pretty straightforward. All right, let's try some of this USAA. This is their retirement tool. And let's go in with an initial payment. And let's do $1 million. And my funding is for retirement. I'm going to say no because I don't really know why they need to know that. How long do you want this for? So we'll try this. The second one doesn't really make sense because that's just an investment. There's no life contingency there. So we'll try lifetime only, and then we'll try guaranteed period. We'll have to write these down. I might type it on my phone so I can keep track of them. So we want to know the impact of age, gender, and guarantees. We want to look at that. Who will receive income? Me only. So we're not going to do the joint, but joint does make an impact. All right, you see my birthday there, male. So we'll do this. We'll do it for me, and then we'll do it for my mom. Calculate. So there's the income. If we do this, does that sound too high or too low? $1 million, I get 5,348.34 for the rest of my life, whether I live 20 years or 40 years or 80 years. I think I'm above average health. Does that help me or hurt me with this product? What are they assuming people who buy this product are? They're assuming you're above average health, right? So it's probably good that I am. If I were below average health, it'd be really, really bad. Right? On life insurance, if you're above average health, that's not good. But if you're below average, that's good. But they're assuming I'm above average health. I think I'm above average, even the above average health of people buy annuities. So I'm probably pretty good off. So I don't want to schedule a call, but I'll still get one just because I did this. So let's make an adjustment. And let's do this for a period certain. And let's guarantee it for 10 years. All right. What is that going to do? So they'll pay me $5,300 a month for the rest of my life. What is guaranteeing 10 years going to do to it? Well, go up 1,000, go down 1,000. What do you think? Go down 1,000 or something like that. Let's see. I'm still the same birthday. Didn't go down much, did it? Would you then do that guarantee? That sounds pretty good. I'm kind of surprised it's that little. Let's adjust it again. And let's now do it with lifetime only. And now we're going to do it. Oh man, do I know my mom's birthday? Sorry, Mom, if I made you too old, but I think that's about right. All right. So 1931. All right, so we got two things going on there. First, female. Does that help or hurt her? I mean, as far as how much money she'll get. It should hurt her, right? Because women live longer. The fact that she's 80, is that going to help her or hurt her? That should help quite a bit, right? So let's look at that one. 21,000. That's pretty good, isn't it? 21,745.23. Now she's below average health. She's had a couple of rough years here recently. So she probably wouldn't do an annuity like this. But she doesn't have $1 million either. She has about 350,000 bucks. So you cut that in half. But it would cover her assisted living, which essentially is all of her, I do her bills and she has a credit card. I mean, it's puny what her credit card provide, what she almost spends no money herself. So most of her assisted living is covered. She does have to pay for Medicare, but her Social Security check covers Medicare. So if she did her entire 350 in an annuity, it would probably take care of her for the rest of her life. But she's got sons to take care of that as well. So, all right, let's see if the period. You think the period certain is gonna be more material for her? Someone who's 80, guaranteeing them 10 years. You think it's going to drop it quite significantly? I would think so. So let's do this. 10 years. Next. I kept that in there. I didn't change her name. That's all right. Well, that had a huge impact, didn't it? So what are they saying is that she's not expected to live the 10 years. And that guaranteed of 10 years, because probably over half the people that are her age are expected to die within 10 years. You can see what that would cut that in half. So the story is women will get less than men. You get more the older you are. The period certain has a much smaller impact when you're young than when you're old. Those are the kind of things you look at. But you can see how great this calculator is. You could make some pretty good decisions, couldn't you, off of this calculator, and sit down with your family and decide. Remember what the article said? Let's at least annuitize enough between your Social Security and this annuity. You're covering those basic living expenses. This would do it. She just doesn't have $1 million here. With 350,000 bucks, it really wouldn't be enough. So annuity would not be enough because her assisted living is $7,000 a month. You cut this more in half, with your Social Security, it's only like $1,800. She just wouldn't have enough. What do you do in that case? She's just gonna have to live off her portfolio and then let her sons take care of her. But this is USAA. Other places have this. The nice thing about this is this is the actual money you'll get, because annuities are not really underwritten, which means you can go out to MetLife, you can go out to Prudential, you can compare these. This is something that is extremely easy to comparison shop. All these things you have here, they're the same for all sites. So this is a product I think is a pretty decent product. They're all doing essentially the same thing. They're buying the same type of bonds, so their fees may be a little different, but this is it. This is what you get. There's nothing else to this product. It's about as simple as you can get. So if you need to buy this product, go out to the big players, New York Life. There's a few out there that are trustworthy. Like I say, USA is always a good one to use because of their competitive strategy. They don't focus that much on this product. So I don't remember ever being in an ALM meeting where they actually talked about this product. So it tends to be kind of one that they sell kind of as a convenience or something, which they should be pushing this product. All right, so there's USA. I'm going to click off. All right, let's finish up a few notes. So last class, I was telling you about these variable annuities. And as mad as I am at the insurance industry, here's someone who actually figured out how to rip off the insurance industry rather than the other way around. This guy, Cara Madre, great name. Isn't that like Face Mama or something? You got Spanish speakers, is that a great name? Cara Madre. So he went in, he read a variable, remember a variable annuity? It's a deferred annuity. It's not a payout, it's a deferred annuity. And it will its balance will change with whatever you put it into. So if you stick it into the stock market, it will go up and down with the stock market. It doesn't have a guaranteed return. However, if you die and the market has been down, you get all your premiums back. So it's essentially one of those hockey sticks, isn't it? If you die, you get all your money back, so you can't lose money if the market's up. So from a death benefit, it works. So what Cara Madre did was he went out and he found people near the end of life, 3 or 4 years away from death, and he bought these products for them, but with him being the beneficiary. So essentially what he said, okay, these people, we're going to put money into this product. When they die, if the stock market's up, I get all the stock market returns. if the stock market's down, I get my premiums back. So he's guaranteed a 0% return. He gets the upside, but he's guaranteed a 0 return. But he's buying this on other people's lives, all right? He considers himself a Robin Hood. The insurance industry says no, he's a con artist. They said he engaged in identity theft. I think there's more to this story that did get him in trouble. They said it was fraud. It says that he deceived the terminally ill, making millions for himself. Now, what he did is he went to the terminally ill and said, hey, I want to buy this variable annuity product. I'll give you $2,000 if you let me buy it on your life and on the beneficiary. So how did he harm them? Did they sound harmed? Some guy walks in and say, here's $2,000. Does that sound good to you? You don't. So I don't know how they said, now the identity theft part, I don't know what he did. Says that he preyed on the sick and vulnerable, but he paid them money. So it's not like he stole anything from them. So this article kind of has my view of the industry, peddling complex financial. Does the word peddling, can you use that in a positive way? My Spanish teacher and I are like, we're doing these phrases in English and Spanish. He's like, could that phrase ever be positive? It's like, no, that one could never be positive. You can't call someone a cheapskate and say, yes, that's a positive. Oh, he's so wonderful. He's a real cheapskate. You know, sometimes we can positive or negative. Peddling to me is almost always a negative. Karamagari said the companies designed the rules. All he did was exploit them. The federal judge agreed with him that he was doing what the fine print allowed. This is a variable annuity. ING is a very interesting firm. I wish I could show you ING. Where it's a firm with almost no net worth. I had a product with ING, and it's amazing. It's like $100 billion in assets and like $4 billion in there. I mean, it's just. And so I called my friend at UTSA. I said, should I be worried about ING? And he said, no, they're so large that the country they're in is going to have to bail them out. So you don't have anything to worry about. So I said, okay, but yeah, ING I've dealt with before. So this is what he's doing. It's that life insurance benefit. If the market crashes and you die, your beneficiary gets a lump sum equal to either the death benefit or the value of the investments, whatever is greater. What's the death benefit? Usually it's the premiums you paid. So essentially you got a 0% guarantee. Not as good as what we saw with the equal-linked annuity, but more of the upside, right? The variable annuities is giving you all the upside, not like the equal-linked annuity is giving you a portion of it. Yeah. It says it is. Yeah, it should be, right? It says recording. Yeah, thanks for checking, but yeah, it should be. Neil, do you see us? Neil? Wait, William Resendez, what are you doing there? William, you're eavesdropping on my classes? William's one of our star alums. He's actually in the wealth management business, so he could probably comment on some of this stuff. So the life insurance company sold about $1.4 trillion worth of these products. Back when the stock market was doing well, except for 2001, maybe not so much. So he says you're getting killed with fees. So he wants to say, how can I give you benefits without you dying? So you insure someone that's going to die, but you make the beneficiary someone who's alive who gets that benefit of the downside protection. All right, so you can go through the rest of this. It's there's some hint in this article, and they don't really tell you. There's some hint in the article that he was doing some unscrupulous stuff. I mean, I said $1,000. He usually paid dying people between $3,000 and $10,000. So again, how are they getting scammed and ripped off? Maybe their benefit, maybe their families like, why didn't we think of that? But they could have done it themselves. So the stealing identity, I don't know about that. There were these two women. boy, I should show you, I don't know if it's Forensic File or Deadly Women, but I watched both of those programs. But there was these two women who were befriending really sick, homeless people on the streets, buying life insurance on them, and they went even a step further and were killing these guys and getting the life insurance. That would be illegal. What he was doing that's illegal is really not covered in this article. It's hard to tell. There seems to be some identity theft, but I don't know how identity theft would actually help him in this. But there is sometimes. So he says they didn't understand that someone else was going to profit. But my word, you hand me $10,000, I'm like, do whatever you want to do, man. So anyway, so there's some debate. It looks like he did get into trouble. But anyway, you can read the rest of it. But that's the fine print in these policies that no one reads because they go on for so many pages. All right, we've covered everything there. There's annuities. So deferred annuities, great products. So let me just real quickly give you my view. So I do think this is really important for you as finance majors and actuaries. And if I can't find, if William really is out there, he can add in his 2 cents on this. So if you need fixed income, this is fixed income. Remember, you're young people, so you're probably going to buy stocks. But if you're dealing with your parents or your grandparents and need fixed income, I suggest you look at 3 things. One is bond mutual funds. Number 2 is bank CDs, certificates. And the last one is fixed life deferred annuities. Now, bond mutual funds, that's pretty straightforward. You go find a bond mutual fund from Vanguard. What do you look at there? Well, you look at the fees. Mutual funds, you don't want to pay high fees. Usually, if you look at the fees, that's probably the best answer because they're all essentially doing the same thing. There aren't bond mutual funds out there beating the others by 3, 4, 5%. I mean, they're beating each other by 0.05%. I mean, it's small. So the fees are really, really key. And then you just look at the current yield. The current yield will give you a good sense of what this bond fund's going to make over the next 5 years. So if we look at Yahoo Finance, let's do a USIBX. This is an intermediate term bond fund. I may actually have this one. Its current yield is 4.5%. That's the rate you're probably going to make over the next 5 years. And Vanguard Intermediate Term Bond Fund, it's 4.49. Are they pretty close? Pretty close. So you can look at the fees. Their expense ratio is 3 basis points, practically 0. USA's was 28. Which do you do? I use USA's because it's Victory Capital, and I probably even know who the manager is. Let's see. Do you show the manager? Jim Jackson. Yeah, he actually taught here. He taught a semester here. I got him. Students love this class, but he was just too busy. Smart guy, really, really good class. So yeah, I still know people there that are, within 2 years of retiring, so I won't know much longer. So I look at those 2 things, fees. I use USA Victory Capital just because that's the team I used to work with. I trust them. I know when I talk to them, they're aligned with their investors. They talk about their investors. So that works really well. Bank CDs, it's the rate. So if you do you know, a 5-year fixed rate, just go to bankrate.com and you can get rates. Just look for the CD rates. CD rates. And, you know, find a 5-year CD. There's some place in here you can change the year, but I don't see it yet. But there is a way on Bankrate. They changed their website, actually. It's kind of irritating now, the way they do it. Anybody see where I can change? Sort by, yeah, highest IPY, but that's probably a pretty short-term one, 6 months. We don't want 6 months. We want to go out 5 years. But boy, why don't they let us pick the year? That would be pretty important, wouldn't it? Yeah, nowhere in here they let you pick the year. By term, here we go. Here we go, finally. 5 years. So between bond mutual funds and CDs, where do you go right now? You can do better in bond mutual funds. All right. Is that always true? No. And I'll explain it why in a second after we talk about deferred annuities. And I clicked out of USAA, so I can't show you that one. Here you just looked at, they have, oh, there's several of them out there. USAA has 3 or 4 fixed annuities. Just look at the rates and the term. So they may be guaranteed for 5 years. The advantage here is that they are tax deferred. It's a huge advantage over these. You do have to pay tax, but you don't have to pay tax while you're earning the interest. So you have to somewhat adjust for that. So why do you look at these 3? So the reason you look at these 3 is this top one is always going to give you current yields. They're going to give you market yields. Whatever the yields are in the market, that's what you get. These 2 are political decisions. They have committees that decide on the rates. And they sometimes offer ridiculously high rates just because they need more. You'll see this with banks. I think Goldman Sachs, when they're trying to get deposits, they had some really ridiculous rates there for a while. The credit union, I was on the board of a credit union. They were offering a 7% CD rate when other CDs were like 5%. And I talked to the president of the board of the credit union. Why are you offering 7%? He said, well, no one's buying them. I said, well, I'm buying one. I had a car loan with them that was like 6%. So it was like, you're going to pay me 7, I'm going to pay you 6. It doesn't make any sense. So you watch those. Sometimes you'll see that with banks, if they're FDIC insured, every once in a while you'll see a bank like it's like 1% higher than everybody else. And you can lock that in for 5 years. Yeah. And with USAA, they had a fixed annuity that was paying a ridiculously high rate in 2008. So I stuck a bunch of money into that, guaranteed for 10 years. And I called the portfolio manager. I go, John, they're paying more on the CD than the bonds you're buying. I mean, they're losing money on, they're paying more on the annuity than the bonds you're buying. They're losing money on every annuity you're selling. He said, yeah, but they have this sales goal they're not meeting. So for the month of December, they're just giving them away, just so you can hit the sale. And I say, okay, I'm buying one. So watch these 3. I would say if they're all about the same, I would go with the bond mutual fund. Now, I know I told you life insurance companies can change these rates, but there is a fixed term. So if it's a 10-year and they have a fixed rate for 10 years, you're going to get that for 10 years. Now, when it matures, you might get a much worse rate, but then you can move the money around. So if you have, especially if you're dealing with your grandparents and they've got like $500,000 or $1 million they're trying to invest, you might dollar cost average it over several months, although right now with the Fed cutting rates, who knows if you shouldn't move faster. But these are your 3 places to go. They're all comparable risk-wise. Bond mutual funds, they're very well diversified, so it's unlikely one company is going to bring you down. This is insured by the FDIC. This is insured by the state of Texas or whatever state they're in. So they're all pretty comparable risk-wise. There's none of them are particularly high risk. You might think the bond mutual fund's the most risky, but they're really all very, very similar. The bond mutual fund will be repriced every single day, so it looks more risky, but the others are essentially getting repriced every day. You're just not seeing it. So if you're helping someone with fixed income, this is really your universe. Make sure on the bond mutual fund, you're looking at investment grade. You're not looking at high yield. I don't know who would buy high yield right now. My word, what a ridiculous product. Here's a high yield fund. Look at that, 656. You're getting 2% over investment grade. 2% is not enough. So I don't know who would be buying high yield. You're just not getting paid. The historical spread is like 4.5%. So you're getting almost nothing for high yield right now. I bought high yield in 2008, but the spread then was 19%. It was massive. But right now you're getting paid almost nothing for high yield. So be careful. I was helping this one gentleman with his, he went to a credit union. They said, oh, we got this great bond. He told me the rate. He said, there's no way they're offering you that rate. He says, oh, no. She said it was a really safe investment. And I looked at it. It was a high yield bond fund. I said, you told her that you wanted low risk? And yeah, I wanted low risk. And she gave you a high yield. So it makes no sense. So that's the yield. Actually, it's 7%, but it's real early small yield. Sorry, I hit the wrong one. 7%. And the expense ratio is probably a little bit higher, but I don't know who's managing this one. Jason Lincoln, I don't know who that is. So they do have 3 or 4 UTSA alums over there, and they are going to be hiring a UTSA student this October, November. So that's the place you want to be. They're hiring an intern, not full-time, but they do have 3 or 4 of our alums as full-time there because they love UTSA people. It's a great firm that work for it. All right. So that's it for the notes. Where do we go next? Are y'all ready for this? Health insurance. This is your big second paper. All right, so let's talk about this paper. I noticed last class we do have a few smartphone zombies in here. I'm not a big fan of smartphone zombies, so anyone stuck on their phone the whole class, you're done for. Your career is over. There's no solution. You can't bring a smartphone zombie back to life. But if someone is one, I wouldn't be one during this part of the class because you got a massive paper to write, but you can probably get over half of it written in the class if you really organize yourself. So what we're going to do, we have a rubric. What you want to do is put the rubric in Word or someplace. You want to have that loaded. I'll let you get that done between now and Thursday. On Thursday, you want to do that. So you want to get the rubric. Let me show you the rubric. It's an insane rubric. Here's the rubric. It's in Excel, but you want to copy and paste that into Word. I'm going to do the same thing. So let's look at the rubric. It's got 3 pieces to it. You've got an introduction, which is essentially the same. What's the problem? I mean, just in numbers. And a big part of that is players and incentives. You can see the points over here. That has more points. We're going to talk about who are the players. The word incentives is huge for this paper. Then you have an entire section on what is the problem. We're going to go in quite a bit of detail on the problem. And in your paper, you need to address every one of these. Now, if there's a problem I discuss that you don't think is a problem, discuss it and then explain why you don't think it's a problem, but at least have it there in your paper. A lot of students, their paper is exactly in this order, which is fine. You might find this order doesn't make sense. You might want to switch some things around, but a lot of students, they put exactly in this order. So you've got some introduction, you've got a massive discussion of the problem, and then you have possible solutions. Again, you need to address all of these possible solutions And if you disagree with them, tell me why. All right. I even talk about a Medicare for all. We'll talk about why I'm not a fan of that, but you can certainly argue that. And in fact, you can go. So you notice on other, there's about 5% or more, about 8% that's other. What could you do for other? Well, you could do Bernie Sanders Medicare for all and just see what we see arguing. And that could be your extra step. You could just say in a paper, I wanted to go in more depth in what Bernie Sanders bill Medicare for all meant and comment on why I think that might or might not work. That could be your other. So I'm not asking for you to go out and look for 40 things. Find one thing that really interests you and add that into your other discussion. Your other can be, you have a family member who's a practitioner, a doctor, a surgeon, a nurse, and just sit down and interview them over Thanksgiving. That can be your other. I've had several students do that, and that works pretty well. Any of y'all know people in the medical community? Relatives that you can talk to? Some won't, you don't want to, well, you want to somewhat ruin their Thanksgiving, but not too radically. So yeah, there's a nurse in my EMBA class, and we started talking about this, and yeah, she had some interesting insights I'll share with you as well. I asked her if she wanted to talk to the class. We'll see. She may be too busy with my class, but I have tried to get medical people to come talk to the class. So you can just about copy and paste it into Word. Let me show you why you want to put it into Word. Let me see if I can get this to work. So copy. It does pretty well, doesn't it? So why do we want to do this? Well, what you want to do is as we talk about something, you want to either put quotes or paste charts or reference class materials. So you can see how using the class time is going to save you a massive amount of time outside of class. Which means what you need to do, if I show a chart you really like, you say, wow, I got to get that chart in my paper. You can tell me, Professor Sweet, slow down. I got to copy and paste that in. Which means you need to know where I am in the data. So make sure you have the same file open I have. And if you see a chart you really like, slow me down, copy and paste it here. So you're going to be putting quotes in. Your paper will have a lot of quotes. Quotes are really important. You'll have charts, definitely. Some of these charts are pretty dated. Your other can be finding a more up-to-date chart than what I have in the articles. Some of these articles are real dated. Some of them pretty recent. I just read one this week. I read The Economist every week. They had a really good article this week on AI and healthcare. I talked to Jonas Puentes. He said AI is the biggest thing going on with healthcare right now, but I think we're saying that about every industry. So, quotes like that, charts, anything you can find that's going to be part of that. So it's really important that you have these three type of things going all the way down the paper, and then just notes. What did we say in class? What's the point we're making? Make sure you understand. Maybe you start with that. Sometimes the quotes are self-explanatory. You don't need much more than the quotes. So like the size of the problem, it's pretty easy to just Google that. U.S. healthcare as percent of GDP is pretty easy to find. 17.6%. And you can do versus other countries. And then, Copilot's the first thing that comes up anymore. So it's easy to find updated charts. Can you see the United States there? Healthcare. This is a great chart right here. So I've had the experience of students coming up and saying, Professor, I can't find anything, and I Google. Well, here's 20 things right here. It's like, oh, I didn't think of Googling that. I'm like, what did you Google? I mean, it's like, whatever you type, it's going to come up. So there's a great paper right there. Healthcare spending. Now, you look at the date, looks pretty good, doesn't it? Right there. Anybody get that that there's like bukus of data in here. I should copy and put this in our class. But anyway, it's easy to get that other credit. So looking for things where you can update from what we have in the class works really, really well. All the way down here, what gets really, really tricky is when we go through the articles, an article may cover 5 of these things. And so I'm going to be jumping around. So you're going to have to slow me down, right? So you make sure so I'll try my best to say, okay, wow, that one really relates to regulation and bureaucratic or focus on treatment versus prevention. So I'll try to get you to the right spot when we're talking about it, but some of them do jump around quite a bit. So you have to get those quotes in there. If you do this in the class and stick with me, you're here every class, or if you miss a class, go onto YouTube and make sure you're doing the exact same thing when you're watching the class by YouTube. If you do that, you should have over half of your paper written by the time we finish this in class. All right, everybody with me? See where we're going? So don't waste the class period because you're just harming yourself. Now, some find this tedious. I don't, because I find every single one of these issues really fascinating. I've been reading about this for years and years and years, and it is amazing to me. I can show you stuff from 10 years ago, 15 years ago, and it's still current. Very little has been fixed. I'll probably give you one night walk to watch a movie, Money and Medicine. It's a PBS special. I think it's on, you can find, I don't know if PBS still even exists anymore, but here it is, a description of it. So you can probably even watch it here, maybe, or buy it. I don't know if this is the actual movie, but I'll give you a link. The link changes every single time. It's a very old movie. It's 20 years old, and it is current. The thing that's not current are the numbers, but the issues are extremely current. I can show you articles from the last 2 months that say exactly what that movie said. So it's kind of sad that it's been a problem for this long. So I love this movie. It's really good. I wish they would make a new one. It's one of those frontline movies. I think it's one of the best things PBS did is these frontline movies, documentaries. They're just really, really, really good. And this one was exceptional. So we'll have some stuff like that. But I mean, I read The Economist every week, and a lot of my articles are about 15 years old. Why? Because that's the Affordable Care Act. So during the Affordable Care Act, there was just massive numbers of articles. So I have a lot from that period of time, but I've updated a lot of them. Recently, in the last year, there's been a lot of articles on AI in healthcare and how AI could radically transform healthcare. So I may give you some more recent articles. I have to stop at some point. I get carried away. I just keep dumping articles out there because there's so many of them. But none of them are refuting the older articles. So it's very, very topical. And you know, it's been in the news because of what's going on with United Health. Obviously, they're the ones that had their CEO was murdered, and you can see what their stock price has done, dropped about in half. This is an industry that has just, United Health is under investigation for fraud and some other criminal events. So you can see this industry is under a lot of stress. United Health is also part of the consolidation issue. I don't know if we'll get into that. It does make me nervous. If you look at CVS, anybody know what CVS does? Their stock price dropped from 110 down to 40, dropped more than half. It's come back here recently, but what did they do? Click on this profile, it should be like 40 pages long. It's like, what don't they do? So what bothers us about CVS? So you think they're retail, you can go buy Cokes. They're a pharmacy. They also provide healthcare. They also provide insurance. Does it make sense in healthcare for someone to own every single piece? Do you want the people providing healthcare to also be the people ensuring healthcare and also selling you the pharmaceutical bill and also doing your PBO and, I mean, your pharmacy? There's a lot of questions. I mean, look at this, my word. This is what we do. This massive, massive, massive. So there's the question of all this consolidation, what is it doing? And that's why this industry is getting in so much trouble, because there's there's some self-dealing going on between these industries. United Health is a similar type of thing. So CVS, Walgreens used to just be pharmacies, but now they're buying all these other pieces. And there's some question about that. So anyway, we don't get into that much, but we might if I find a good article. I did find some TikTok-like videos that are very, very, very into this particular issue and what's going on. I don't think the trial of the person who, I forget the guy who, this is kind of touchy. His trial will probably be like 2 or 3 years off, right? It takes forever to do these trials. Second degree murder charges. I don't know why it's second degree, but anyway. Defense argue that the federal death penalty is unconstitutional, so they may seek the death penalty. And he has people out in the streets saying he should be let go because he didn't do anything wrong. That's how much anger there is with this industry. That seems kind of crazy to me, but that's the kind of anger in this industry. All right, so you see where we're going. What we'll do, let me just get you started. How many of y'all got this set up already? Anybody? Y'all got it going? All right, so if you don't have this going, we're going to start with this. So we'll be under this defined insurable event. We've already done that, but we're going to start with that. Let me show you the articles we have. So you have the rubric. So the first couple classes, we're going to be on these first 2 articles. So tonight we'll start with this first one. We call it insurance. It's an old article, but it's so perfect for what we're dealing with. And it's still very, very timely today. And then this article. Now, the reason I'm giving you these 2 articles to start with is I've got a very, very libertarian conservative writer here. And I got a very far to the left journalist talking about healthcare reform, both with the same conclusions. The 2 of them could not be further on the political spectrum than they are, and they both agree. So it's interesting. So we'll start with this one. So any questions on this paper? Have you ever written a paper in class like this before? It's kind of a unique experience, isn't it? Very, very different. I think it's the best way because it's so complicated, it's so deep, there's so much going on. I think it's a good way to tackle it. All right, let's start with this article. We may not get, well, we'll see if we can get through most of it. So it's written by Merrill. He was the commissioner of Washington, D.C. You might say, well, that sounds like someone far to the left, but he was appointed by President Bush. So the actual Republican president appointed him. He's not a Republican. He's more on the libertarian side, but more on the conservative side. So he does a great job. This is 24 years old, 25 years old, back when Bush was president, right before 9/11. He wrote this. And what he's saying today, trust me, this isn't like a lazy professor who doesn't want to find new articles. This is as he could have written this last week and it would have still worked. So he wants to say, what is it about health insurance that is so different than life insurance, auto insurance, homeowners insurance? Why is it that health insurance is messed up and these others are not? And he comes down to what we talked about in the class. What is an insurable event? Now, do y'all remember in class what we said? We said it's high blank and low blank. Anybody remember that? High severity and low frequency, all right? See if he doesn't say something there. It's something that very unlikely to happen. What does that sound like? Low frequency. It will come without warning. That one is the accidental part of it. Come without warning. It is not something the person wants to ever happen. That definition applies to catastrophic. What does catastrophic imply? High severity. All right. He's got a few things in here. Come without warning somewhat implies that it's accidental. It's not intentional. So think about your doctor visits. When's the last time you had a doctor's? It's like, you're like, whoa, I'm in the doctor's office. Wow, I didn't know how to. Like suddenly you go to sleep, you wake up, and you're in doctor's. Hey, how did I get here? Oh, you're in for your annual checkup. Oh, wow. No, you plan it, put it on your calendar. You know in advance. You probably don't do that with your car accidents, right? It's like, yeah, I can't make it to lunch. I'm having a car accident next Thursday. If that happens, that's insurance fraud. You can't do that. You don't want it to happen. Do you know people who've had pregnancies and had babies and they wanted it to happen? Anybody know people like that? Probably, hopefully all of your parents want that they wanted you, and you know, even if you were surprised, they're glad you showed up. So that's a little different. That definition applies to catastrophic health events. It does not apply to routine health maintenance. All right, so you kind of see what he's saying is health insurance period should cover high frequency, low severity, accidental, bad things. Period. That's what it should cover. It should not cover routine things, high frequency, low severity things. It shouldn't cover, he's not going to say medical, he's not going to talk about maternity. That's the dangerous one. The second article, he actually does address maternity. I would never do that. I'm not going to say pregnancy shouldn't be covered by health insurance. I don't want my tires slashed, but the second article, he does talk about that. So the paradigm of payment of healthcare tries to cover both catastrophic. So it does cover catastrophic, but it also tries to cover regular healthcare in one sentence. He says it's a built-in contradiction. Why? So if I were doing quotes, you don't necessarily, are you going to put the quote in your paper? Sometimes you do quotes just to help define the problem. So you might, as you go to Article 1. Now in the paper, I don't need a bibliography, but you need to keep track so you can go back and find it if you need to. All right, some have something. So if the only time you need the cite is the stuff you pull that is not part of the class material. All right. So from Article 1, you can do the Article 1, 2, 3 just by looking what's in. So 1, 2, 3, 4, 5, you can count down every time. I won't add anything new in there, so you could definitely do that. So as we go, you see something that really helps explain it, then copy and paste that in. The current paradigm for payment of healthcare tries to cover catastrophic and regular healthcare in one sentence. He says it's a built-in contradiction. Why? So he explains it really, really well. The insurance system works best. How? When few people use it. What makes people mad about health insurance companies? When they deny claims, right? That's why the CEO of United Healthcare, more people are more mad at him for health insurance than they were for healthcare. But what about the healthcare system? What do they want? The healthcare system wants you to use it. They get paid for volume. That's the contradiction. So you got one side that says, hey, we want as low usage, we want to deny claims. The other side says, we want to treat you as much as we possibly can. And then we throw in the question, what if the insurance company is also the health provider? That gets really confusing. We'll have to talk about that. All right, so you see where he's going with this article? You can almost tell where his conclusion is going to be. And you're going to see that a lot in these articles. The biggest problem with US healthcare is overuse of insurance. We have way too much health insurance. He says the goals are incompatible. You want one group wanting as much usage as possible, the other group wanting as little usage as possible. He talked about managed care. That's not so important in this paper because it's somewhat being challenged. But what managed care did was try to control these. What managed care said is, okay, we'll cover routine coverage, routine checkups, but you're going to have a gatekeeper. So what we're going to try to do is keep you away from a specialist. So we don't want you to go to a knee specialist, have knee surgery. We want you to go to a practitioner, and they'll decide whether you go to the knee. So we'll spend extra money for routine care, but that'll keep you away from those high-cost specialists. That was the idea. But that infuriated everyone because they were denying payments because some treatments were not medically necessary. Now, we'll talk about the UK. UK is often put up as the best system. I'm going to have a few articles on the UK in here, not because this paper is about the UK, but I want to show you that most of our problems in the US, the UK has the same problems. So their system hasn't solved all the problems. They do have lower costs. But what does the UK say? They deny a lot of service. I mean, it was interesting. There was a case, there was a family in the UK that wanted treatment, really unique treatment for a child. It was experimental, and UK said, we're not covering it. So the family said, well, we'll just go to Italy and get it, and we'll pay for it ourselves. And the UK said, no, you can't do that. Can you imagine that in the United States? Well, you say, hey, it's my life. I'll do what I want. And the UK said, no, your child has to die. That's experimental treatment. I don't care if someone in Italy wants to give it to you. I don't care if you want to pay for it yourself. You're denied. That's how intense. People talk about the UK system. I don't know if it'd work in the United States. Do you think Americans would let the government say, no, you're not getting that treatment. You will die. You're not getting that treatment. We're not covering that. It's too expensive. But that's the UK approach. So it's very different. But that was somewhat the managed care, and they got a lot of trouble with this. So what did legislators do? We'll talk about this. Legislators say, well, we'll just mandate that you have to cover these things. So governments try mandating. And when you force hospitals and doctors or insurance to cover things, what are insurance companies going to do? Are they going to charge more or charge less? And charge more. Is that unreasonable? Seems reasonable. Should legislator mandate these type of things? Who knows? We'll talk about what's going on in the doctor's office, but we'll get into that. That frustrates insurers. So you've got this conflict where one side saying we're not going to cover that, the other side says cover everything. Legislators are trying to make voters happy. And then you get down to the other thing he covers in this paper are the players. So Article 1 really answers most of the players and incentives. Let's see if y'all can think of the players. Who are the players? We mentioned a couple of them. Let's start with you. Who are you? The patient or the insured? Are you part of this equation? What can we say about you? You receive services without paying for them. How does that work? How does an economy work when the people using the service don't pay for it? Do they tend to overuse the service or underuse the service? Overuse the service. Who else do we have? All right, well, okay, well, we can do the insurance companies. Before the insurance companies, let's talk the buyer and the doctors, right? So you got the medical practices. And who is that? That's doctors, hospitals, pharma. That's not how you spell hospitals. But you have insurance companies. Doctors, what do? They provide the services. Insurance companies, they pay for the services. But why are they doing that? Boy, that's kind of nice of them. Who pays them? Employers. For most people, right? Most Americans are covered either by their employer or by Medicare. What do they want? As the goal of an employer to provide you the best health insurance possible, what do they want? What do you think their incentive is? I would say the cheapest possible before employees leave because the insurance. Isn't that their goal? They want to find the cheapest possible they can do, but you still stay. So essentially, good enough, but not the best. So their incentive is not to provide you the best healthcare. Now, I could push back on this a little bit because I know at USAA, I was on the committee that did all this. The committee, they had to make these decisions, but they were also what? These people. So they had some incentive to provide really good care. So they weren't completely, say, the cheapest possible. So it was interesting. But they did have to try to keep the cost down. They couldn't just give you the greatest possible. Who else is involved in this? I mentioned them in here. Legislators, governments. They're the one that set policy. They have a huge impact on this. We're seeing that now with the shutdown. I don't know if we're going to have a shutdown tomorrow, but the Democrats are saying if we don't do anything, Affordable Care Act premiums are going to skyrocket. We got to bring them down. Why are they skyrocketing? They're skyrocketing because costs are up, probably. But they're going to set policy. They have a pretty big impact, especially with Medicare. So he talks about the players, and he does get into that. Healthcare services are negotiated not by the affected parties. So you have the patient and medical practices. They're completely out of this equation. These are the people who decide everything, insurance company and employers. The people who are actually using the services and providing the services, they're just taking whatever they're given after those two parties negotiate. Very, very different than any other type of insurance. So healthcare services are negotiated not by physicians, hospitals, consumers, but by insurers and employers. For good and competitive reasons, employers try to find the least expensive plan they can. So they can in terms of still keeping their employees. Same thing with salaries, right? I mean, they could pay you $40 million, but they're going to pay you the cheapest they can pay you, and you take the job and not go somewhere else. So it's the same thing with the healthcare. So their goal is not to give you the best plan possible. Their goal is actually give you the worst, cheapest policy they can, but it's good enough to keep you there. All right. So there's the players. You might be able to think of some other players. There may be some we'll see in here as we go through. But the key is the players and the incentives. What do patients want? They want everything. What do practices want? They want to provide services. Insurance companies, they want to pay as little as possible. We'll talk a little bit more about insurance companies because this is essentially a cost plus business. If their costs go up, they have to cover more. They just charge more. And so there's a little bit of a kind of a fight between employers and insurance companies. Insurance companies could say, hey, if we got to cover more, we'll just charge more. But they do have to watch out because if they start charging too much, the employers will start passing more of the costs on to the employees, and that can have an impact. So there's a little bit on the incentive side that's a little tough. Legislators, they want to get re-elected. So they tend to keep things overly simplistic. It's a very, very difficult problem to solve. Fortunately for you, for this paper, when we get to the solution, your solution doesn't have to be politically viable. So you can, anything you want to propose is perfectly fair game that you think, all right, let's stop there. Y'all see where we're going, all right? So don't waste this class up. So I see someone on their phone, I'll probably be in tears that you're wasting your life. Quick review, make sure everybody's ready for the exam on Tuesday, right? On Tuesday, you'll walk in here and you'll have one math problem. You get to leave after the math problem, so you don't have to stay the entire time. You want to take the entire 75 minutes. It shouldn't take you that long. But you have that math problem. And then on Canvas, you need to answer these two questions, two essays, submit them as one essay. So there's only one assignment on Canvas. There's not two. So submit them, the two essays in one document. Right? Any questions on that? So you have a paper, but the paper's not due until after the exam. There's really not much on that paper that's in the exam essays. You could work it in there, but it's probably not going to really help you that much. However, there is definitely some overlap on the two essay questions. We talked, the most obvious one is comparison shopping. An ethical issue with life insurance is the complexity of the products. When you're looking at term versus whole life, term is much simpler. So there is some overlap in those two. In fact, when I grade the papers, if a student does a really good job of discussing it in one of the essays and leaves it out of the other one, I'll sometimes give them credit for having brought it up. If they brought it up in a way I could see it applies to the other question, but best is to put it in both questions. So any questions on the essays? The second one's a tough one because I didn't really give you an answer. I gave you the pieces that you have to organize, and so that one's a little tougher. I've seen a couple people with their exam essays, and not very many. I'm kind of surprised people have never had them before. Are just going to chance it. Some students, it's like, well, what if he doesn't like it? I go to him, I don't want to get embarrassed, but would you rather be embarrassed in the FSC with me sitting there talking to you, or when you get the grade back? I don't know which would be more lesser. And I'm not too cruel, am I? I'm not like, I don't like demoralize people and say, well, that's the worst answer I've ever seen. My goal is that you be successful. So that probably will be Tuesday or Wednesday because Mondays are pretty packed. All right, so no questions here. Yeah, that's part of the critical thinking. You got to figure it out. Your boss will never tell you that, so yeah, I don't usually have to figure it out. The worst answers are usually way too short. They just almost cut that in half. Just stuff. Just because you have the point doesn't mean you know it. I need to understand, what does that point mean? What does asset gatherers mean? So, make sure you're explaining it in a way that makes sense. Some students is like, yeah, but of course I know. I'm the one that's asking the question, but I'm reading it as someone who doesn't necessarily know this issue and reading it. So it needs to be readable and understandable to someone who's not taking this class, who's, the general knowledge of finance. All right, anything else? So there's no way I'll get them graded by Thursday, but I promise I'll get them graded by Monday. So hopefully that's fast enough. It's tough for the class of 40 and essay questions. The toughest one's your healthcare paper. That one, oh my word, that's my entire Thanksgiving holiday. But this exam, I can grade a little faster. So I'll definitely get it done, but I won't get it done by Thursday's class. There's just no way. All right, so are y'all ready for the healthcare? You've got your rubric up in Word, right? Everybody's ready to go, or you're taking notes? If you're taking notes, you're going to have to write really fast. So you may have to slow me down. So if you're taking notes by paper, which is actually, I think, preferred, normally here, it's probably good to have a laptop, but if you're taking notes you might make sure you know where I'm pulling, which article I'm pulling from and what page I'm on. So we're right here and we call it insurance, and there's only 2 pages. So I copied a lot of stuff from page 1. So make sure you have that up in goings, because you can write most of this paper in class. So don't be surfing the net or checking emails. I promise you, they'll like your Facebook posts. You'll find that out at 7:30. You don't have to know that now, so let it go. So last class, we got in this first article where he defined an insurable event or insurance, but he said healthcare doesn't meet that definition because it insures high frequency, low frequency events. It should cover only low frequency, high severity events, but it covers high frequency, low severity events. Doesn't make sense. Why? Because insurance wants as little activity as possible. The healthcare system wants as much activity as possible. So you got this contradiction. And now we're talking about firms that own both the insurance and the healthcare. So we got some really strange incentives. This article does a good job on the players and incentives. You can probably do that, most of that here. We'll talk more about these players and incentives. Definitely, we're going to talk about the some of the asymmetries on the medical practice side. So the next thing he's going to do is get into the solution. So I'm going to go down to the solution section. And obviously, he's already talked about this one. Insurance should only be sort of high severity, low frequency. He's already said that. But he's going to talk, in fact, most of his solution is going to be in this section. So let's go back to the article. So we talked about the incentive of the employer. They're trying to find the least expensive plan for you. They're not necessarily trying to get you the best health care possible. So the fact that you're not buying your health insurance or your health program, your employer is, you've been somewhat taken out of the picture. You're just making sure, you may have one employer that's going to pay you $100,000, but with the Class B healthcare, and the other one's going to give you $80,000 with the Class A healthcare. Man, it makes it really tough. How do you compare between the two? We'll talk about what if your employer just paid you $140,000 and say, hey, get your own healthcare. Leave me out of it. Would that be a solution? So yes, what is the answer? So is universal coverage? He doesn't get into it much. You could quote him on this, but we'll get into it more. The last book we're going to look at is going to talk a lot about Medicare. A lot of people on Medicare love Medicare. A lot of people don't love Medicare. Hospitals and doctors don't typically like Medicare. But we're going to talk about how Medicare has a financial problem. It's extremely fiscally unstable. But he doesn't like the government plan because he is a libertarian. He says, I don't think government can solve these issues any better than the private insurers have been able to. And a monolithic healthcare system run by the government is scary to me. So that's not his solution. It can be your solution. But if it's your solution, you're going to have to address the issues we bring up about this. And you think our federal government has a deficit, you think Social Security has a deficit, you should see the deficit just for Medicare. It's a freaky, scary number. And it's going to get worse, right? Because you have all these baby boomers. So here's a solution. First of all, it's a two-tier system. One tier is for catastrophic. We're dealing with two different tiers here. Catastrophic and in regular care. So catastrophic is where you need insurance. And he's going to argue for what? High deductibles. So his solution is less insurance. We're going to see that a lot. Now, when we get to Article 2, so this guy's far to the right, he's a libertarian. The Article 2 is far to the left, a journalist. He also wants high deductible. What do you think the second article's high deductible is going to be? Higher than 5,000 or lower than 5,000? Do you go lower when you move left or you go higher? You would think lower. So we'll see the shockingly surprising answer in the second article, because it's not just higher, it's off the charts higher, so we'll see. So what he's saying is high deductible. Why this is really important? Makes it relatively inexpensive. Why? Because you're not going to the system all that much. We're going to talk about the cost of insurance here, and we'll get into that. Let me bring it up now because it's up here under the problem. Oh, where did I put it? So the very, very first one, inefficiency of the insurance model. Very, very first one up there. Something I want you to think about is the Affordable Care Act. Bill Gates won't let me go left. I don't know why, but Affordable Care Act. Insurance must have a payout, a claims payout ratio greater than equal 80%. What does that mean? That's healthcare claims paid divided by the premiums received. So what does that tell you? When you give the insurance company $100, how much do you expect to get back on average? $80. You paid for it yourself out of pocket, how much would it cost you? $80. So how much does just the fact that you have insurance, how much does that raise the cost of healthcare? And don't say 20%. How much higher is healthcare going to cost you because the insurance company is getting there if they're going to take $100 of your money but only give you back $80? That you could have just spent $80. So what is it? If it's not 20%, what is it? You're going to spend $100. You could have just spent 80. How much higher is that? What actuaries? What's 20 divided by 80? 25%, all right? Oops. I don't know what I just did. What does that mean? That means insurance increases healthcare costs by 25% just to have the insurers in the equation. That's why he's saying it's more efficient and you have low frequency, because the less you only want the insurance industry to get involved in those very, very high costs. And really, when you have those high costs that are low frequency, they don't add 25% there. Most of this 20% are for doctor visits. It's all that paperwork. So like when I go to the dentist, I have dental insurance. I hand them my credit card, I sign the receipt, and I leave. If I have insurance, they got to get my insurance card. They got to copy it. Now they have to mail something to the insurance company. There's now a transaction back. I mean, most doctor practices, this would be something you could ask if you have a medical person in your family. Most doctors' practices will have one or two people who are simply their insurance people. So you have a staff of 20 people, 2 of them might just be your insurance people, because you got to take care of all this paperwork. If there's no insurance involved, they look like Walmart or Costco. You just walk in, give them a credit card, and you leave. All right, so that's part of what they mean here. Everybody ever get that point? That's what the government requires. Now, is this really true? We're going to see an article. That one's not even true, because insurance companies have found tricky ways to reduce their payout below 80%, but make it look like it's 80%. So in reality, they're not paying 80%. They're paying something less because of some accounting gimmicks that they have. But if we just go over the Affordable Care Act, yeah, every time you use insurance, it's going to raise the cost 25% because you have this entire insurance bureaucracy going on behind it. This is not untrue for auto insurance. So those that took my auto insurance class last semester, the combined ratio is usually about 95%. So their payout ratio is 95%, but does that mean you pay $100 and you get 95 bucks back? No, because what is their payout ratio? It's claims and loss adjustment expenses. Their claims might be 75%, loss adjustments 20%, only 70. So you spend $100 on auto insurance over your lifetime. On average, you're expecting to get 75% back. 25% is going to go to the insurance company, 20% to handle their adjusters and expenses, 5% is profit. So anytime you buy insurance, yeah, you're better off in your life if you don't buy the insurance, except for those years when you have a $20,000, $30,000 claim. If you can't afford that, then yeah, you're in trouble.
I think I heard this question, but why would you kind of option?
It's those extremes. So if you completely lose your car, you can't get to work, you look at all the downside. But mathematically, like if you're doing remember net present value in your finance courses, you can't do net present value for health insurance. You can't do it for auto insurance. It's always going to be a negative number because you're always going to pay more. You're expected to pay more than you're going to get back. However, every once in a while, you're going to get a whole lot more back than you paid in. Over your lifetime, you're probably going to spend, I don't know, 40,000, you'll get 28,000 back or something like that, or 32,000 back. I've paid into auto insurance and I've gotten nothing back. So I couldn't go without because Texas law requires me to have it. But I reduce it as much as I can. So my Part D, in fact, I canceled Part D once my car hits a certain number of years. Like when my last Prius hit 11 years or 10 years, I just completely canceled Part D. Right? That's the collision part. It's anything happens to your car physically, I just completely canceled. I can't cancel Part A because the law requires me to have Part A. So on auto insurance, you have to have the liability piece, but the liability is not that expensive. Your most expensive part's that Part D, and then Parts B and C, I don't buy at all. Right? That's the big debate we had last semester. I don't even buy it because it's exactly your point. I'm not going to buy insurance if it's low enough severity I can handle it myself because I know over time I'll pay less for it. Same thing with warranties. Some of y'all might have the Apple phone warranty insurance. I don't buy that. Anytime a firm offers me some kind of warranty, I'm just not going to do it. When you're getting a rental car, they used to offer insurance. They don't push it much anymore. Yeah, usually if they're pushing it for you, it's because it's extremely profitable to them. If it's extremely profitable to them, what does that imply about the payout ratio? It's probably pretty low. Why do rental car agencies like, oh, please buy our auto insurance? Why? Because they make a fortune off of it. Why? Because they're going to pay you so little on average.
Sure, if I buy a lot of the Part A, and it's like profitable to the insurance company to buy Part A.
Well, Part A is so low frequency. It's pretty low. It's not that expensive for Part A. You can, like, I have an umbrella policy. I mean, it just goes up. It covers me millions of dollars, and I don't even notice the bill. It's really small. So Part D is more expensive because a lot more stuff can happen on Part D. So yeah, and then one way to get around Part D, you don't have to cancel it. You can just raise your deductible. That's another way to kind of reduce, because then your severity has to go above the deductible before the insurance company cares. So the insurance companies, it's going to be more expensive the more times you go to them, because now they have to hire employees, handle the claims and those kind of things. So when you have low frequency, high severity, the payout ratio should be lower because you're going to the company much less frequently. They don't have to do all that paperwork. When you think about relative, you're going in for $1 million surgery once in your life. You think about the insurance costs there versus you go to the doctor twice a year for $100. Where is the insurance part of that equation going to be larger? It's going to be those $100 visits, right? There's not a lot of extra work for the $1 million surgery versus $100 doctor visits. I'm talking about the insurance piece. Obviously, the medical side is massive, but we're talking about the insurance piece. Whether you file one claim in your life, you file 2 every year, the small 2 that you've filed, the insurance cost is going to be a much bigger percentage of that. So low frequency, high severity things should have a much lower insurance impact. You don't need them as much. So that's why it's relatively, he says the word relatively, that doesn't help you, but relatively, but it's kind of for the amount of coverage you're getting versus the cost of the insurance, you're getting a lot more insurance because there's just not that much insurance cost in the equation. We talked about the upper limits. I like unlimited, but insurance companies don't like unlimited. So one of the things people like about HMOs is they have unlimited coverage. If you think about that, the insurance keeps covering you if it's $1 million, $2 million, $3 million, $4 million. But what does that do to your insurance? It could raise the rates quite a bit. But most of us like unlimited because there are some medical procedures that will save your life that are just incredibly expensive. In some countries like the UK, they're going to say, yeah, we can save your life, but your life's not worth $4 million. So tough luck. We're going to see a video. The video I want you to watch, it's the hardest part of the video to watch. It's really sad. And so I'll give you the preview of it. The man is in the hospital. His mom's comatose. The doctor says she's brain dead. She'll never come out of it. They ask him, do you want us to let your mom die or do you want to keep her alive? And what does he say? They ask you if you want a loved one to live or die. What do you say? He says, let them live. All right. That's going to cost a few $1 million. Keep her alive for 6 months. And he says, of course, pay whatever you have to. Why is he saying that? How much of that is he going to pay? Zero. How much are we going to pay? The entire amount. Is he the one that's really making that decision? If Medicare is paying for it? What if he had to pay the $6 million or whatever it is? Do you think his decision would change? So that's what we're looking at here. That's where this lifetime, it can be a lifetime or an annual limit, but so HMOs don't have annual limits, but a lot of insurance now is starting to put limits on there. That's kind of the UK model. The UK model says, yeah, we can save your life, but you're not worth it. And why does the UK say that? Instead of keeping his mom alive, let's say it's $5 million. What could we do instead? We could fix the water system in Flint, Michigan, right? We could put curbs on streets so people don't get hit by a car. You know, we could save what, 40 lives for what we're going to save that one life. So in the UK, they say, hey, it's an opportunity cost. We can't spend $4 million keeping you alive because we can keep 10 people alive, spending that money somewhere else. So that's part of on the limit side. He doesn't get into it much, but that's part of the limit side. That's because most people do not get catastrophic illnesses or injuries. Such insurance would also cover the cost of any chronic illnesses is an issue. We'll talk about that. There are people with chronic illnesses, so they're going to exceed that deductible every single year. But at least they're out of pocket the first $5,000. So yeah, that's an issue. So what do you do with everything else? The second tier, out of pocket. Y'all know what out of pocket means? You're going to pay it yourself. Y'all don't have to copy the entire thing in there. Insurance is not the answer. Pay these costs out of pocket like we do everything else. Like, how do you pay for your oil changes for your car? Does your auto insurance cover that? Would you want it to? Let's see, wow, my oil change is $70, but hey, I can buy this auto insurance policy. It's only $90 and it will cover my oil changes. Does that make sense? Anybody do that? It'd be like, what? There's actually an article. I lost the article, but it was so good. This firm raised its deductibles $1,000, but cut its insurance premiums $1,200. So the employees were going to be $1,000 out more out of pocket, but their take-home pay was going to be $1,200 higher. And they quoted this one woman in an article that says, I don't know how I'm going to afford that $1,000 deductible. It's like, you have $1,200 you didn't have before. And that's a lot of Americans are, I should never pay a penny for healthcare. And what he's saying is, hey, you should pay the $100 for healthcare rather than paying $120, $125 for insurance. It's just much smarter. Or he's going to say, for the poor, what do you do? For others, he's going to talk about medical savings accounts, which we're going to get into that as well. Essentially what he's saying is, you know what? People don't like paying for healthcare. We're going to talk about the taxes. I don't like the second answer. Why is he saying this? This is a huge tax advantage. What is a medical savings account? You essentially get to take pre-tax dollars and put in a savings account and spend it on healthcare. So essentially what you're doing is you're not having to pay tax. So if you got a 20% tax rate, you can put $1,000 in a savings account. You don't have to pay the $200 for taxes. You get an extra $200. So that's the MSA approach. We'll talk about MSAs. Or for the poor, what does he say to do? Have the government purchase a membership from a prepaid plan. So for the poor, he's saying, you know what? We can't just let them die in the streets. And he is a libertarian, but he's accepting the realities. If we say, hey, you gotta get your own health care, and someone doesn't get health care and they show up to the hospital and they're dying of a heart attack, the hospital's not gonna say, tough luck, you don't have insurance, you're gonna die in the streets. We don't do that. So somehow that's gonna be covered. So he's suggesting a government purchase emergency. I don't think he's thought through this part as carefully as the rest. I think his main point is the first part. Let's don't use insurance to cover routine stuff. You're gonna find the two biggest issues for me is overuse of insurance and our tax code. And the two are closely tied. We'll get into tax code later. Why does the US overuse health insurance? Not health care, but health insurance. And it's because our tax code, more than any other country in the world, our tax code encourages. It's the biggest tax benefit in our tax code. And who gets the most of the benefit in the tax code? By wealth. The wealthy benefit more or the poor benefit more? The wealthy is heavily skewed to the wealthy. Why? Because of the highest tax rates. And so when you shield all of this income from taxes to provide health care, it's the wealthy who benefit. So we'll talk about the tax code. So we use insurance too much. Why? Because our tax code was set up to encourage us to use too much health insurance. I got to be careful, and you're going to notice me mess this up. I will interchange in health insurance and health care. They are two different things. You're going to see in the second article, he's going to be critical of me mixing those two. Healthcare and health insurance are not the same thing. So his main point is not that we're using too much healthcare. His main point is we're using too much health insurance. You can see his solution, pretty straightforward solution, and that's his article. So his article sets up, our problem is we don't understand insurance when it comes to health insurance. It's not normal insurance. We need to fix that. And so his problem is the definition of an insurable event when it comes to health insurance. And his solution is, let's get back to that definition. All right, so there's the first article, a short article, an old article, but still very topical today. He could have written this article today, other than the HMO discussion, because HMOs really have radically changed. I don't know what I need to say, but I'll save it just in case. All right. Everybody's with me, or y'all keeping up? I'm going too fast. So I'm loading the second article, if you want to load that up. How Healthcare Killed My Father. Really great title. He also has a book. I got his book and read his book. The article actually covers the book pretty well, so I don't know if you really need it. He's a journalist. He uses that in the article. You can do that as your extra 10% or your extra points a family situation. I've had people use their own situation and talk about the frustration with this entire system. But he's talking about his father. You can somewhat see from the article, he didn't have a good experience. So this one jumps around a little bit. So I'm going to go in the order of the article so you can stay with me, but he is going to jump around a little bit. He's going to jump around between problems and solutions, all right? So one of his solutions, one of his problems you can see in the title, and that is under problems is this one right here, poor quality, poor medical care quality. I forget what he says, but we can find it. I think it's coming up pretty quick here. So this sentence right here, we'll get more detail on this, but how did Americans learn to accept hundreds of thousands of deaths from minor medical mistakes as an inevitability? So I forget, we'll see in an article. I can't remember if medical mistakes is the second leading or third leading cause of death in the United States, but it's way up there. It's pretty shocking. And we'll see that, especially when we look at some of the data. A lot of it is leaving stuff inside the person when they do surgery, operating on the wrong side of the person, doing the wrong procedure on the person. So what is his solution there? If you go down to solutions, his solution is hospital checklist. Let's at least get rid of the problem. So he talks about the provenance checklist. I don't know if you have heard of that before. If you have someone going to the hospital, I would read into this. So these checklists, instantaneous success reducing hospital infection rates by 2/3. But many physicians rejected the list as unnecessary, bureaucratic. We'll see another article later where this one's kind of scary. It made me ask my surgeon a question, but they did a video of surgeons going into surgery to see what percentage of them washed their hands, and it was a really low percentage. And then they told them they were filming them, and the percentage didn't go to 100%, went to like 90-something%. But a large percentage of surgeons weren't washing. So that's the question I asked my surgeon before he cut my throat is, did you wash your hands? And he's like, oh yeah, of course I did. And I was like, yeah, I don't trust you. But there are some pretty obvious things people do in hospitals that increase risk. The other thing you'll see in here is this one right above it. We won't get into that one in this article so much. But if hospitals are required to report their quality standards, how many people did they kill on the operating because of a mistake? When hospitals have to report quality, their quality goes way up. So what are hospitals doing? They're fighting having to report qualities. In fact, we'll see with, I think it's with Porter. What's the best indication of a hospital's quality? Any guesses? There's one thing you can do that would tell you better than anything else. And wouldn't you want to know that if you have someone going in for surgery? Any guesses? Well, if you can't get that data, but yeah, I mean, so what hospitals will say is, yes, like UCLA, you're going to see it in the video. UCLA is beat up in this video. Yeah, we cost more and we have more deaths, but that's because we're so great, we get the worst cases. So some hospitals say, yeah, but we're just so good, we're getting worse cases, so of course more of our people die. So no, the number one indication is you ask nurses, would they have surgery in their hospital? And the answer to that, what do you think nurses, how accurate are they, do you think? They're pretty accurate and they're pretty honest. So if you get a group of nurses that say, I would not have surgery in this hospital, do you want to have surgery in that hospital? I would say absolutely not. So there are ways, but right now, most Americans go into major surgery with no clue if the hospital they're going to and the doctor they're going to is any better than average. And we're going to see the quality ranges between hospitals is extremely wide. And there's some surgeries, especially for prostate cancer, you kind of want to know what the side effects are going to be. And there's some hospitals it's very, very low, some hospitals very, very high. I would bet your granddads would like to know the answer to that before they went into surgery because it is extremely wide range. So there's a simple thing we can do. Why does he bring that up first? Well, because that's what his article is about. His dad died in the hospital because of just a mistake the hospital made. Not only that, but the hospital made a whole lot more money by killing his dad than they would have if they had saved his dad's life. Why? Because they infected him, and guess what? He had to come back to the hospital, get the infection treated, and then he ended up dying. So they made a lot more money killing them than they would have keeping them alive. So I don't know if any of y'all watch, what's that TV? Can't remember, a lady's name is in it. Can't remember. What is it? Grey's Anatomy. They had a provenance Grey's Anatomy. Y'all probably, it's probably way before your time. It's not still on TV, is it? Means she's got to be a lot, like 87 years old now. Like, she's still a doctor. But one of the doctors did the provenance, and it's really interesting how they did it. Is that she got a lot of resistance. We don't want to do this, and then in the process, she proved it wasn't Gray. It was another doctor, but she proved the checklist actually saved some lives, and the doctors started coming around slowly. It was an interesting one, just seeing that in action. And then at the end of that program, they had an intern that was just bumbling intern, and they finally fire him. And at first, you're kind of feeling sorry for him, and on the way out, he goes in to treat a patient, and in the process, gives her an infection, and she ends up dying. And so they make the case that he was fired for good reasons. He wasn't following protocol, he wasn't careful, and so he ended up killing. So this is huge. And it's he asked, so Jack in the Box or whoever it was, I don't know, this might have been Chipotle. This is probably Jack in the Box, but they have a little bit of a mad cow disease or something, and man, it goes throughout the entire country. 5 people die, but hospitals are killing hundreds of thousands because of mistakes, and we don't hear about it.
Was things changed here in Texas as a result of what happened in the Dallas area 2 years ago with that guy, Dr. Death, that's what they called him?
Oh, I haven't heard that story.
He named, out of the 38 patients that he treated at the Plano medical facility he worked at, he named 33 of them, killed 7.
I've seen stories of doctors that were just so bad.
Well, apparently longer passed right afterwards. I saw something about it recently. So
Yeah, you could add that to your paper. I'd be interested. There have been laws specifically related to equality, and hospitals fight them pretty hard, but a case like that might be a way to get it passed through pretty fast. Yeah, do you think it's effective? Do we have evidence error rates have come down?
I think the law is 2023, so I'm not sure what.
That'd be interesting. I mean, would you go to a hospital that refuses to report its quality standards, says we just don't want to do that? I mean, their argument is, well, there's more to it than those standards because every hospital are different, or we're in an older neighborhood, so we're gonna have more deaths. To me, report it and I'll make the adjustments, but yeah, it'd be interesting. So I'll have to look that up. Yeah, if you find an article, send it over to me. I saw the one where the doctor was creating TikTok videos and dancing around during surgery, and he got in trouble. That's usually not a good thing to do, but so there's part of the problem is low quality, and why is that? So why is healthcare so different than other industries? And we're going to talk about that, but a big part of it is because of insurance. The presence of insurance changes the relationship between the buyer and the seller, because the buyer and seller is employers and insurance companies. It's not the patient and the doctors. The doctors are not serving the patient. They're serving the insurance company and the employer. So a lot of the reasons why you have these problems that wouldn't exist in any other industry. It's the thing to always be thinking. why is health insurance so different than any other industry? And that's because of the insurance equation. It changes our behavior, it changes the behavior of doctors. All right, so let's get into some other things. All right, so he starts off with whom do we blame? So this is part of the, who are the players? So I suspect our collective search for villains has distracted us and our political leaders from addressing the fundamental causes. All of the actors in healthcare, so doctors, we talked about that, insurers, pharmaceutical companies, work in a heavily regulated, massively subsidized industry full of structural distortions. They all want to serve patients well. I think we're going to question that statement when we see some of the fraud in insurance, like doctors giving people cancer treatment that they know don't have cancer. I mean, you give someone, you know how bad chemotherapy is. You give someone chemotherapy and you know they don't have cancer. I don't know if they want to serve patients well, but they also all behave rationally. I love this sentence. I'm going to put this at the very beginning under the players. They all behave rationally in response to the economic incentives those distortions create. There's that word, incentives. Extremely important word. The reason it's so important is the insurance itself changes the incentives of the players. Doctors aren't paid by their patients. The patients don't have information to be able to shop doctors. You know, the incentives are all out, and the patients aren't paying for it. So we got to ask what those distortions are. So he'll obviously cover that some in his article. So incentives that emphasize health care over any other aspect of health and well-being. This is a big part of his argument. It's an opportunity cost. And he's going to give us the numbers. We'll see his numbers. I don't know if you can trust his numbers. This is a pretty old article, so it'd probably be new numbers today. But so emphasize healthcare over any other aspect of our well-being, that emphasize treatment over prevention. You're going to notice that's one of the problems. Treatment is more emphasized than prevention. That disguise true costs. We'll talk about that later. That favor complexity and discourage transparent competition based on price and quality. We'll get into that a little bit more. That result in a generational pyramid scheme rather than sustainable financing. We'll see this in the last article. You guys should be really upset. But the Affordable Care Act essentially said, you wealthy elderly people, you're paying too much for health care. Let's shift that all down to young, poorer people. Because the young, poorer people, they don't have as much money as you do, but they don't vote like you do. So we'll just throw it. And that's, you guys are subsidizing. Most of your grandparents are wealthier than you, aren't they? Maybe not the whole classroom, but most of your grandparents, because they're retired, they've worked in industry, maybe not all of you, but the baby boomers are the wealthiest group of Americans out there, and they're being heavily subsidized by law. The Affordable Care Act requires hospitals to undercharge the elderly and overcharge the young people. And how do we know that's the case? Because how did they get the Affordable Care Act passed? They said, we're going to require people to buy insurance because we need young people in the system to keep costs down. If you're an actuary, you should be like, that makes no sense. Have you heard anyone say, we got to get more 40-year-olds driving cars so we can reduce the cost of auto insurance for 25-year-olds? Anybody heard that before? Does that make any sense? What would you say? 40-year-olds should pay for insurance for 40-year-olds. If they're better drivers, they have to lower rates. We shouldn't overcharge them so we can undercharge. Well, y'all might like that, right? Overcharge 40-year-olds, we can undercharge 25-year-olds. Well, what do they do? 25-year-olds have to pay their full share, 40-year-olds get to pay the lower rate. But what do we say with healthcare? 60-year-olds, you have high costs, but we don't like that. We're going to shift that to young people. But you got to get more young people to join the system. So what does that mean for you young people? You're being grossly overcharged. So you can subsidize the elderly. It does not make sense. In fact, someone that helped develop the Affordable Care Act, he was quoted on a hot mic, essentially saying if young people knew what we were doing, they would have pitchfork and they'd be in the streets protesting. That got caught. He didn't want that caught on tape. He got recorded. I think I have that quote somewhere in one of these articles. So you guys should be mad. That's what he means about these the generational kind of problems going on here. Generational pyramid scheme, and it's not just. I saw one of my friends. Oh, she's very, very wealthy, on Facebook saying people over 65 shouldn't have to pay property tax. Someone's gonna have to pay the tax, but we just want to have you guys pay everything. We hit 65, we got our millions saved up, but we're elderly, we shouldn't have to pay for anything. We should push it all to you guys.
That's actually, one of the constitutional, I think it's part up for a vote this one.
Oh, in Texas, really?
Yeah.
The one don't tell me. Oh, I can't remember. Tell me your name again. Christian, I knew that. Is that what Christian was talking about? Or what you're talking about is already passed? Was it an amendment or was it a House bill? Yeah, put that in your paper, Nathan. I mean, I'm really curious about stuff like that. It's state by state. It gets a little tough for me to keep track of what's going on state by state, but insurance is regulated state by state. What particularly was in that bill, Nathan? Related to property tax?
Yeah.
Yeah, I mean, my generation is we're like picking your pockets left and right. And we're making you feel guilty about it. We're stealing from you and making you feel guilty for us stealing from you. It's quite the, see, I'm gonna ruin your Thanksgiving. And that most important, remove consumers from the irreplaceable role of ultimate insurer of value. So we'll talk about consumerism as a solution. How do we get in health insurance and health care so it's like the other things that we buy, where we're actively involved, looking for the best quality, looking for the best price. How do we change that? So we'll get some of the stuff he's saying is important, but we'll get other places that get to it more directly. What about Affordable Care Act? This is pre-Affordable Care Act, but this essentially he's alluding to it. Comprehensive reform being contemplated merely cements in place the current system. Insurance-based, he doesn't like. Employment-centered, he doesn't like. Administratively complex. It addresses the underlying cause of a healthcare crisis only obliquely, if at all. Indeed, by extending the current system, more people will likely increase the ultimate true cost. So why are the Democrats allowing the shutdown? What are they fighting for? Reduce Affordable Care Act premiums. Why are they going up so much? Because costs are going up. So the Affordable Care Act does appear to have changed the slope of healthcare costs. We have to kind of debate if it's really the Affordable Care Act or something else going on. So you could definitely talk about Affordable Care Act in this paper. I'm not looking for anything on the Affordable Care Act. This is not a dissertation. I had one student in this class essentially find an article on Affordable Care Act and copy and paste it and turn it in as his paper. I find one place to give him a point. It's basically essentially copy and pasted the entire thing. It's like, I think he took the wrong class. It might have been a paper he wrote for another class and he just turned it in for mine too. It's like, that's why I use crazy rubrics. It really makes using ChatGPT a little bit more difficult. But all right, so he doesn't like the current solution, and my guess, if we could get President Obama here and get him, if he knew he was off the record, I think he would agree with a lot of this. I think a lot of what he would say is, I had to do what I could get past. I think President Obama wanted to address the cost side. So this is the supply and demand problem. Affordable Care Act really focuses on the demand side, but doesn't do much about the supply side. He's saying the problem is on the supply side. In the Affordable Care Act, let's get more people insured. Well, if the problem's on the supply side, getting more people insured, you're just creating more volume into a broken system. So we'll talk about the supply side because that really is a big part of this. But I think President Obama would actually agree with that. But he saw what happened to Bill and Hillary Clinton, and President Clinton proposed this and got completely wiped out. they were focused on the supply side and it got them crushed. It just doesn't work politically. So, some of this, you get the advantage, you don't have to make yours politically feasible. I also believe that unless we fix the problems at the foundation, problem of incentives, our reforms won't do much good and may do harm. Healthcare will need to become, you could kind of work that sentiment into your overall conclusion, but then make sure your paper talks about it. We're going to talk about how to change incentives. Michael Porter, the very last thing we're going to do is his article. He talks a lot about how to change the incentives. How do you change the incentives from treating people to making us healthier? How do you get it from volume to quality of healthcare? Healthcare will need to become subject to the same forces that have boosted efficiency and value throughout the economy. We'll need to reduce insurance, focus government's role exclusively on things government can do, protect the poor, overcome our addiction to Ponzi scheme financing. That he's talking about kind of borrowing to keep this going. Hidden subsidies, manipulated prices, and undisclosed results. We talked about that, right? Hospitals not reporting how well they've done. And rely more on ourselves, the consumer, as the ultimate guarantors of our good service, reasonable prices, and sensible trade-offs between healthcare spending. So if you needed a good quote for this section, this is probably a little much. But under the solutions, we're going to get into this quite a bit. This idea of go down to solutions and this idea of unlock consumerism. We'll get into that quite a bit. How can we get consumers of healthcare to do what they do when they're buying cars and buying swimming pools and buying cereal, be that kind of shopper when they're buying healthcare? I bet people spend a lot more time picking their car than picking their surgeon. In fact, most people don't pick their surgeon, do they? They go to their ENT, and the ENT says you need surgery, and then who operates on them? Your ENT. I made that mistake. I may talk about my situation. I wish I'd say I want a second opinion. I want another ENT. Do you want your ENT to be your surgeon? If you ask a barber if you need a haircut, what will they say? They'll say yes. You ask the surgeon if you need surgery, what are they going to say? Yeah, you need surgery. So there's a conflict of interest, right? He makes more money if he cuts me open, and he says, hey, I think I need to cut you open. You're like, yeah, sure, whatever. Go for it. Before spending another $1 trillion or so on reform, we need a much clearer understanding of the causes of the problems. So part of its solution is not in my rubric so clearly, but it kind of is hinted at it. What he's saying is we're spending a lot of money on health insurance and health care, where there's other things that have shown to be more important to our health and our well-being than hospitals and doctors and pharmacists. So public safety, improving the environment, infrastructure, education, these are all effective. We know the food industry is out to get us. Y'all all seen those stories of the cigarette companies bought food companies, and they say, hey, we knew how to addict them to nicotine. Now we're going to addict them to processed foods and sugars. And you're seeing RFK and some of the stuff he's going through. And I can say I'm pro or I read RFK's book. It's a pretty incredible book, but he is addressing the food industry in a way that some people love. Some people are saying he's hitting on the wrong stuff. But it's interesting. I read the book. I can't remember the name of the author, but all of my friends have been reading it, and they're all losing weight first time in their life. It's pretty amazing. But they're doing things that my high school said to do the exact opposite. So it's kind of interesting. We're all experimenting with this, but it's definitely an issue that it's more than just that's prevention, right? There's things we can do so we don't have those ailments, like have better ways to ride bikes to work or whatever. I love to ride my bike to UTSA. I tried it once a few weeks ago and almost got killed twice. very, very dangerous, and construction around here is really, really bad. It takes me about 40 minutes to ride here and 20 minutes to drive here, so it's not a massive extra amount of time. But it's just way too dangerous, 1604. It's just crazy. But it'd be nice, there are bike paths to get here, but they add another 20 minutes to the trip. But yeah, some places like in Europe, it's really easy to get around. Education, teaching people. The nurse who's in my EMBA class, she was talking about Japan and Costa Rica. I didn't realize Costa Rica, but in Japan, they start in kindergarten with heavy eating on dietary things and all, stuff that try to avoid some mistakes we make. But yeah, I mean, it's tough. The environment, infrastructure, we know with Flint, Michigan, with the water supply getting, having lead added to the water supply, I mean, that just destroys kids' minds. It's really going to set them up for just horrible things that they'll work on the rest of their life. He's saying, what if we spent money fixing the water supply where it's tainted? Wouldn't we have much bigger impact on health than spending all this money on the healthcare system? So we have other priorities. By what mechanism is society determine the extra $100 billion for healthcare will make us healthier than $10 billion for cleaning the air, $25 billion for better nutrition, $5 billion for parks, $10 billion for recreation, $50 billion in addition to vacation time. So that's part of his argument. He uses the housing market as an example, where the tax benefits and subsidies cause us to build more houses than we should have, and the whole thing blew up on us. So distorting demand, raising prices, making us poorer by crowding out other possibly better beneficial uses. So I like this idea. This is the kind of the economist approach, is everything's an opportunity cost. Politicians don't do that. Politicians just say, hey, I spent $100 billion on that. Look at that wonderful bridge. They don't say, hey, we could have built, all this over here. We could have built a whole new sanitation system, but instead we built a bridge that goes to an island where 3 people live. That's a much better use of $100 billion. Yeah, we got to start thinking opportunity costs. And Porter is going to talk a lot about that in his paper. All right, so here's what I was talking about. Health insurance isn't health care. And when I read this article, it was during the Affordable Care Act, and I noticed exactly what he's saying. Politicians say millions of Americans don't have health care, but that's not true. What they meant to say was millions of Americans don't have health insurance. That's not the same thing. They have health care. It may just not be covered by insurance. But he's asked, how has a method of financing healthcare become synonymous with the care itself? I think I even heard President Obama say, millions of Americans don't have healthcare. And I do it by accident as well. Health insurance is different from every other type of insurance. Health insurance is primary payment mechanism, not just for expenses that are unexpected and large, but nearly all healthcare expenses. Sounds just like that first article, doesn't it? It's covering the high frequency, low severity stuff. We've become so used to health insurance that we don't realize how absurd that is. We can't imagine paying for gas with our auto insurance policy, or our electric bills with our homeowners insurance. We all assume our regular checkups and dental cleanings will be covered by insurance. Most pregnancies, now this is where he gets in a lot of trouble. I'm not saying I agree with everything he says here, okay? So don't slash my tires or anything. Most pregnancies are planned. The deliveries are predictable many months in advance, yet they are financed in the same way we finance fixing a car after a wreck through insurance claims. He does not like the insurance model. You're going to see that over and over and over again in these articles, from the left, from the right. Now, Kamala Harris, when she ran against Biden, 2020, she made a mistake of what? Let's get rid of employer-provided health care. Health insurance, how did that go over? That essentially ended her presidential run. All right, y'all probably don't remember that. You're probably in elementary school or something back then. But yeah, I mean, in the debate, she said because it's the Democratic debate, it worked there. Doesn't work really well. Most Americans like having employer-provided health insurance. And when you say eliminate that, obviously that's what Bernie Sanders is saying. We've gotten so used to it. We just expect our employer to buy the insurance and our insurance to pay for everything. We don't want to pay. We get so mad. Oh man, I got to pay $40 for my prescription drug. That's insane. Well, it's a $400 prescription. $40 doesn't sound all that much to pay. No, I shouldn't have to pay for anything. Just doesn't make sense. But what about pregnancy? So we'll get into that one. What he has to say about it. What's the thing with pregnancy? It is planned. You do know in advance, but what else do we know? It's very expensive, right? So people are saying, so some people, well, I won't go too far into that one. So comprehensive health insurance is so ingrained in our thinking, we forget that its rise to dominance is relatively recent. And here he brings up the tax. This seemingly minor tax ban, and it is not minor at all, encourages catastrophic insurance and all other insurance. So what is this tax benefit? I'll show you here and I'll give you quotes later. This is an incredible tax benefit. There's no other tax benefit in our tax code like this. So if you get a 401k plan, what's the tax benefit there? You get to put pre-tax dollars in the 401k plan, right? So instead of you getting paid $1,000, you have to pay $200 in taxes, then you put $800 in your 401k. You could put the $1,000 in 401k. You don't have to pay tax on that. But when do you ever have to pay tax on the 401k? Yeah, when you take it out at the end. A Roth IRA, you put money in, you don't get the tax benefit then, do you? But you never have to pay tax. That's usually where our tax code works for those kind of things. You get tax deferral, you get the tax deduction at first front, but you pay it later. Health insurance, it's tax deductible to the employer and tax free forever employee. It is the best tax benefit we have. It's a few $100 billion in our tax code. It's extremely expensive. Do we have any kind of deficit issues in the United States where $300 billion that's predominantly going to the wealthy is maybe an issue? Huge tax benefit. There are several people who think that's the first thing you got to fix our healthcare system. It's the reason why we're so different than Canada and the UK and these other countries. We have this incredible tax benefit. Where did that come from? It came during World War II. The government froze wages, told employers, you can't pay your workers more. We need people in the Army and the Air Force. We need to watch. So employers said, you know what? We can't pay you salary, but we'll give you health care. We'll give you health insurance. And so they said, well, how's that going to be taxed? And the IRS says, well, it's tax deductible. I said, okay, well, does the employee have to pay tax? And the IRS said, no, it's not taxable. Now, there's a big debate about it, but it got into law that the employer gets a tax deduction, the employee gets a tax-free, and it just stuck. If that had not happened, we'd probably be in a radically different place today. So we'll talk about this one. What would be the case if your employer did not buy your health insurance, but instead gave that all to your salary and you went out and bought it yourself? You'd immediately lose that tax benefit. Your employer wouldn't lose the benefit, right? They still get the tax deduction because they're paying you, but you would lose the tax benefit. But I'm going to try to prove to you, you would still be better off even after the tax. But we're going to talk, this is huge. We'll see some other. This is one where you can probably get more updated numbers than I have and see what the current benefit is, but it's quite huge. So he says seemingly, and I think the word seemingly is correct because it is it is the largest tax benefit in the U.S. tax code that had accidental effect of having us overbuy insurance. Overbuying insurance has two impacts. First, we've had way too much insurance. But secondly, when insurance pays for everything, what do we tend to do as consumers of medical care? If someone else is paying for everything, what do you tend to do? You overuse it. So a good example is HMOs. All you have to do is pay like a $10 fee up front. So parents were taking their kids, they knew had a minor cold, but taking them to the hospital, coming to the doctor, get aspirin, just in case it's a bubonic plague. I mean, there's a 1 chance in a billion, so just in case. If they had to pay $100 for that trip, would they do that? No, if the kid has a cold, leave him at home in bed. But when you're only paying $10, why not? Go to the doctor, might get some free pills or something, who knows? So and we'll see an article that talks about how much overuse there is. We overuse the system. Now the UK has the same problem where everything's provided by the government and they pay for it through the taxes. How does the UK handle that? By saying no. We do not cover that. They're having big problems today, but the reason they're cheaper is they just say no a lot. In the US, we don't like saying no, so we overuse it and the system is forced to pay for it. I'm going to bring this one in. I like this quote under the insurance model, that very first one under the problems. It's a great quote. Insurance is probably the most complex, costly, and distortional method of financing any activity. That's why it is otherwise used to fund only rare, unexpected, and large costs. Had 2 people agree on this from 2 very different sides of the political spectrum. Now, these are old numbers, but the insurance piece of this does add a lot of cost to the system. We've already seen that. Much of this enormous cost would simply disappear if we paid for routine, predictable healthcare expenditures the way we pay for everything else out of our pockets. All right. So that's a big part of it. You can probably update this number to $2025. Society's excess costs from health insurance expenses. Health's next to damage, a moral hazard. This is really a morale hazard. The tendency we'll have to change the behavior, becoming spendthrifts and otherwise taking less care with our decisions. So when there's someone else is paying the bill, we're not good consumers. We overpay. Every time you walk into a doctor's office, it's implicit that someone else will be paying for most or all of your bill. For most of us, that means we give less attention to prices than we do for anything else. The informational advantages that extensive training has given physicians or patients and the authority that advantage confers. You have a system where physicians can create their own demand. I'm going to copy this one. You'll notice in the problems, we'll see this in other places, but it actually goes in a few places. Where did that put it though? Yeah, this one right here, informational asymmetries and supply creates its own demand. We'll get into that more. That sounds real similar to the life insurance side, right? Insurers can sell these really complicated products because of that information asymmetry. A doctor says, hey, I think we need to give you knee surgery. So, well, what do I know? I mean, doctors, I always read, you know, I'm ready with Google. I went into my doctor and said, I think I have walking pneumonia. He kind of rolls his eyes at me, but I was right. I got it right. But it's like, you come in with some disease that you only get in, you know, some island off the coast of Australia, and you can, I think I have this disease. Like, yeah, probably not. So, you know, doctors have a lot more training, a lot more knowledge, but they also have an incentive to treat us. So let's take knee surgery, for example. Doctor says you need knee surgery, but the studies show people who don't get knee surgery are just as well off 5 years later as the people who got knee surgery. So the knee surgery has no long-term advantage, but it costs a whole lot more. Should insurance pay for both of those? One is doesn't cost anything. You just, you know, you do some exercises. The other one, they operate, costs you $20,000. Well, you have a doctor who's there advising you, you need surgery. You could ask, you know, could I just exercise better? Could I go to therapy? Is there something better? And the doctor is probably not going to tell you that, yeah, that's been shown to be just as good. They're going to operate on it. If they operate on you, what's going to happen? Well, you got a chance of getting some infection. They operate on the wrong knee. That happens a lot. They do the wrong side. So we'll talk about doctors have an incentive to treat you, and they're the ones that are the experts recommending what you do. All right, well, we'll stop right there because I want to I love this new topic. This is proof of the distorted incentives, and you'll see it in here, so we'll start on this one next. Any questions? Y'all staying up with me? I see some, not here, I see some head nodding, so I think you're staying with me. All right. I know it's crazy, it's insane, but I love this topic.